Hey folks, what is an index fund? The who, the what, the when, where, why, and how. Just start with a disclaimer. This isn't financial advice or legal advice. These are just my opinions. I'm not selling anything. This is focusing on the US. Sorry if you live elsewhere, and this is just for educational purposes, so I hope you enjoy. What is an index fund? Well, it means an investment that matches the performance of an index. And an index is just a list of assets that are grouped together by some common characteristic. So instead of making active investment decisions, the fund just tracks the performance of that index. So what is an index? Well, an index is tracking a large diversified group of assets that share some quality or characteristic. And a good example is the S&P 500, although there are many others. So what are some examples of an index? For large capitalization domestic stocks, domestic meaning United States, the S&P 500 is a great example, although there are many others. And I've also listed some other types of asset classes that have indices and some examples for small cap domestic stocks and total stock market and bonds and emerging markets and developed markets and the entire world stock market. There are many other types of asset classes that have indices, and there are other indices for each of these asset classes, not just the examples I've given. That should give you sort of a sense of what we're talking about. This is a way to track a large number of assets in a single index. So how do index funds work? Well, index funds, they avoid using any active independent judgment. The managers are not making decisions. They're just tracking the index and trying to copy its performance, trying to get the returns of the assets that are included in that index. So all the fund has to do is buy the index assets in the same proportion, the same assets. So it is the opposite of an actively managed fund. So how does a fund work? What is the fund in index fund? Well, it could mean mutual fund, or it could mean ETF, or exchange traded fund. Both of them are just different ways to purchase a large grouping of assets. A mutual fund pools together the investor's money and then buys stocks, bonds, other assets according to the fund's strategy. An ETF is a little bit different. It's traded like a stock, so it's traded all day, and it also holds underlying assets. Just they're both baskets of assets. So you can buy a fund, you're buying all of the assets underneath it. For the regular retail investor, all you need to know is a mutual fund is priced at the end of the day, and an ETF has a price that changes throughout the day because it's traded like a stock. So what makes an index fund different from an active fund? How are they different? An active fund has its own investment strategy. They're going to use expertise or research or analysis or some magic formula to try and beat the market. And often this is really needed so they can attract more investors, so that they can justify charging fees. They really need to tell you they're going to beat the market. An index fund uses a passive strategy, the opposite of active. They're not using independent expertise or research or independent decisions. They're doing what the index is doing. They're just trying to match that. So that's what active versus passive means, whether you're making decisions or you're just following the index. But what is the distinction between index and passive? So they are not exactly the same thing. Usually someone talking about passive is referring to index. And usually when someone's referring to index, that is also passive. So all index funds are passive, or at least to the extent that you're indexing, that's a passive strategy. You're not using your own independent active judgment. You could have a non-index passive fund. That is possible, they do exist, but for the most part, these two things are going to overlap significantly. The important thing to remember is all indexing is passive, but not necessarily all passive is indexing. So why do we even have index funds? Well, you would use an index fund because it has lower costs. Because they're not using independent research, independent decision making, they don't need to come up with the magic formula. They don't need to check the market and figure out what's happening. They just track the index. It's very simple. And if there are lower costs, more money is going into the investment and less money is going to expenses. So that's good if you want investment returns. You get more investment for your dollar. Now, why else might you use an index fund? Well, you would get the market rate of return for the asset class of that index. So whatever the index is going to get, it should reflect the market rate of return for all of the assets that are included in the index, which should give you a pretty broad swath. And that means that you can match the market rate of return. You won't beat it, but you shouldn't fall under it either. So that's a pretty good deal, because a lot of active funds tell you that they will beat the market, but as we'll see later, most of them fail to beat the market, especially when you consider their expensive fees. So why is an index fund simpler? They're not claiming the magic formula. They don't say they have special insights. They're just saying, this is an index. We'll track the index. This is how much we'll charge you for the process of tracking an index. An active fund, however, is very different. It can be varying levels of opaque. It can be difficult to hold the fund to account because you don't know exactly why they're making their decisions. They're telling you they have some special sauce, some magic formula that's going to get them above market return. Well, you don't really know that. They can be very flexible. That means that they can avoid accountability. The only accountability is whether you're going to invest in them because they're beating the market. But as to whether their individual decisions make sense, it's very difficult to figure out whether it was good or bad. Sometimes it might take years to find out if a decision an active fund made was good or bad. Many of these active funds will turn on the reputation of their managers, and in fact, a retirement in this context could be very bad. A fund could fold if a very popular manager has a reputation for being a wizard or a genius, and then he or she leaves. So it's just very different in that sense. An index fund is very straightforward, and there's no mystery to it. So why does an index fund work? Why does it get you the market rate of return? So this could get too complex, and we're not going to go into it, and I'm certainly not trying to sell you anything politically controversial when I say the basic argument is something called efficient market hypothesis, or EMH. So let's just avoid overstating it. Let's not go into the strong or controversial version, but the consensus version among most economists is relatively apolitical, so that a well-traded market, which is liquid and has access to good information, is going to reflect very good prices. And that means there aren't a lot of opportunities to beat the market. In other words, to find opportunities where a price is too high or too low and you can buy or sell an asset until the price moves. The simpler way to put it is, no matter how super smart you are at investing, there are tons of other super smart people out there, and they're also investing. So even if sometimes you can beat them in the short term, it's very difficult to beat all the other super smart people all the time reliably. It's just difficult to reliably come out on top because of EMH. And that's the simple answer. All you need to know is EMH implies that if you can invest in the entire market and get the market rate of return, that will be safe. That will work. And if you're trying to beat it, that will be difficult. So that leads into, why is an active fund risky? Well, it's difficult to beat the market, but not only is it difficult to beat it, in your attempt to beat it, you expose yourself to extra risk. And that means that often trying to beat the market gets you below the market, so you did worse. Especially when you consider the fees of your active manager that they're charging you to try and beat the market. Now, why do you want to even settle for market rate of return? Isn't that very bad? Isn't that low standards? Well, no, market return, it's often very good. Especially if you have time, if you have a few decades or more, it's great because of compounding, and it often beats inflation and housing. And again, this is focused on the US, but long-term inflation and long-term housing are just not nearly as reliable as the US equity markets, especially for large cap, well-traded stocks. That's historically the returns over a long period. If you can wait a few decades, the long-term annualized returns are very good. So market rate of return is great. So when are index funds going to be good? Well, if you're okay getting the market rate of return for that asset, for that class of assets, then an index fund is great. That's what it's going to give you. It's especially good if you have lots of time to just leave it alone. A decade is good, 30 plus years is better, but an index fund is especially important when you can admit to yourself that you don't have any special market insights, so you're okay getting the market rate of return. Now, when would an index fund be bad? Well, generally the opposite. So obviously, if you think you have unique market insights, if you have the magic formula, if you have the lottery ticket, the secret sauce, go ahead and invest. If you desperately need to beat the market rate of return, you'll never get that in an index fund, or at least you shouldn't. Your asset class, market rate of return, that's what you're going to get in an index. So if you have to beat it, don't even try an index. But there's this other situation when a market is not very well understood or when it's difficult to formulate an index. So this is especially true with unique goods that are just not very liquid, like individual parcels of land, not real estate in general, not REITs, but individual parcels of land. They're not liquid. They might go years without being traded, so you don't have a good price history there. That's also true with startups, individual startup companies. They might not be liquid for years, and they might not have any trading. There might not be any good pricing information. So it can be hard to price both of those things. And cryptocurrency can be a challenge, especially individual cryptocurrencies. So these are just challenging to indexes. It's not that an index couldn't exist, and certainly there are real estate indices and there are other indices that try to get at some of these assets, but for a lot of these things, an index is just inappropriate and might not even exist for the particular individual types of assets that you're looking at. You need a large amount of assets that are well traded and liquid so that we really know the prices. Some people also try to argue emerging markets, which are developing or middle development countries, primarily China and the BRICS countries. That sort of target, which is not the poorest countries, but not United States, not Europe, not Japan, Australia. Some people try to argue that so-called emerging markets are better for active investors because those sort of wise wizards, they have the magic formula, they know how to do it, and the index just doesn't work. And they argue a similar thing for international, non-US, smaller capitalization companies. Now, I'll argue later that that's not the case, but you will hear that said. So when should you use an index fund? Well, use it when you want a low-cost option. You want to get the market return, especially if you have years until you need to spend your investment, and when you're willing to admit that you don't have any magic formula, you don't think you can beat the market. Index is perfect for that situation. And active is the opposite. If you're comfortable spending a lot on fees relative to a passive index fund, if you're comfortable with the risk that you could lose to the market because you really need the chance to beat the market, then active fund is appropriate for you. Although we'll go into how difficult it is to actually pick the right active fund, and maybe you'll change your mind. And I want to just reference this old poem from Regency era England, and let's ignore all the historical connotations and just focus on the story itself from Ozymandias, which is a traveler in some empty desert sees a pedestal, and the pedestal says, "My name is Ozymandias, King of Kings. Look on my works, ye mighty, and despair. Nothing beside remains." So you've got this guy who finds a pedestal in the desert, bragging about how great this King Ozymandias was. Look, read it and weep. And then there's nothing there. It's just ruins. So all that's left is just this empty boast of a long forgotten king. So the application here is watch out for hubris. Don't let your ambitions make you forget your limitations. Now, digging into the numbers a little bit, just a little bit of the performance, when do index funds beat actives? The short answer is, in the short term, index usually beats the median active fund, except for maybe some downturn years. But that's true even at the 1 year and 3 year period. And then if you look at long term, at the 10 or 15 year period or longer, index just incredibly dominates over active funds. Active funds have a lot of trouble beating the index, especially at the longer term. The reason for that, long story short, is usually because the actives are making decisions like hedges and other short-term investment decisions based on fluctuations they're seeing. They're going for short-term opportunities, either to avoid losses or to go for quick gains. But that often comes at the sacrifice of long-term gains. So we've actually got some numbers that seem to bear this out. But what it means is index is usually best if you're going to wait a while. Retirement funds are a great example. If you're not going to retire for 10 years or longer, index fund is almost always going to be better unless you just find a really great active fund or you just get lucky. So let's look at what's called the Stiva scorecard. These are different asset classes. They're all focused on US funds, but the simple way to read these charts is each of these 6 charts has a dotted line. Below the dotted line means most active funds beat the index. If the blue is above the dotted line, that means most active funds did worse. They underperformed the index. Now, as you can quickly see, most of these are almost entirely above the dotted line, and even when it goes below the dotted line, it just barely scratches it or dips slightly below it. So what you should take away from this is most active funds are just getting trounced by the index. They are not doing very well. So if we look down here, this is where we would see active funds in years they beat the index. And up here is years that actives lose to the index. Now, let's just look over here at US real estate. You can see there's a little bit on the left-hand side where for some years, just a little bit of a majority of the active funds were beating the index. What's going on there? Well, if you look at those years, 2005 to 2009, that's the real estate bubble and the Great Recession. So what this is was hedging. They hedged because they saw where real estate was headed. The index, again, does not make independent active decisions, so it barrels right into a recession, barrels into a downturn. It doesn't flinch. The active managers flinch. And that can produce these short-term successes, short-term victories. It looks as though they're winning because they're making decisions to either go for quick gains or avoid short-term losses. But they're sacrificing themselves. And as you can see later on in the real estate, they did much worse after that. So I think that we should probably focus quickly. I just want to bring up the international equity funds, and you can see similar results where mostly active funds are losing to the index. Now, if you look at international small cap funds, you will see there are some years here where actives are beating the index. Now, most of the years, it looks like it's relatively close or the index is beating the actives. But there are several years in there where the majority of the actives, the median active, was beating the index. And this is one data point that people might present as a reason to think that for international small cap funds, index is less appropriate and that active is more appropriate. Now we'll go look at the long term in a minute and we'll see that I don't actually accept that argument, but this is what they're looking at when they make that argument. However, if we look at the emerging markets, and again, this is countries like China or Taiwan that are quickly developing and quickly growing, emerging, where we're sometimes told that actives are better than index, we can see for all of these years the actives lost to the index on average. The median active fund lost to the index. So if you were in most of the active funds, like most of them, you would have lost out. So it doesn't seem even appropriate here. And this is just for the 3-year returns. When we get up to 10, 15-year returns, we'll see it's more lopsided in favor of index. So I want to focus specifically on large cap funds. A good example, this would be the S&P 500 is the most famous index, and it is a large cap index. If we look more specifically at 3 different types of large cap indices, we have growth, core, and value. Now, very basically, growth is for growing companies. It's more volatile. Value is trying to find undervalued or underpriced high-value companies that are not growing quickly. It's low volatility. And core is sort of in the middle, or a blend, it's sometimes called. It has no emphasis between growth and value. Now, if you're looking at the bottom, same rules. Below the dotted line means most active funds outperformed or matched the index, and above the dotted line means they underperformed the index. That index was better. You can see there's a period there where value was, on average, beating the index. Doesn't that disprove what I'm saying? I mean, maybe large cap value is good for active. Well, you can see over here, first of all, that over the entire period, all of the growth, core, and value funds, all 3 of those types, the majority solidly lost to the index. The median growth or core or value active fund would have underperformed the index. Value did less badly, almost 71%. So that means that 70.91% underperformed. That's not great. Not if you have to pick, right? That's 7 in 10 odds that you're going to pick one that underperformed. Growth and core did even worse, so you would be much better off in index there. But ultimately, all of these suggest that you should pick the index. But why is it different? Why is it that value did less awfully? Well, if you look, we can see more evidence of the hedging. See, that's those years where the value active funds were outperforming or matching or outperforming the index, 2008 through 2011 or 12. Well, that's after the Great Recession. And just bear in mind, these are rolling 3-year returns, so they reflect the previous 3 years of performance. So it's a little bit, so 2009, for example, would go backwards to 2006. The previous 3 years' returns are kind of rolled together. But this is the aftermath of the real estate bubble and the Great Recession. So what happened is those value funds were hedging. And that hedge cost them. So if we look ahead to solidly after the Great Recession, you can see they got those short-term gains, and they looked better than in the index after the recession, but the long-term gains were sacrificed. So they sold the future for the present. And that's not great unless you really need short-term gains. Most people, however, are in this for the long haul, more than 3 years at least. So that's really the problem, and that's why actives can be really dangerous, because those active decisions, the managers flinch and they don't want to lose their shirt, so they start selling off assets, trying to avoid a downturn, or they start making gains in the opposite of a downturn during a boom, and they try to chase higher gains. Well, those are short-term decisions that humans make. But if you just stick with the index, you will experience pain in a downturn. But if you can just wait a few years, you will be better than if you had flinched. And that's really what I'm trying to get across here. And so these are the 3-year returns. We're going to try to look at longer returns. This is the same information. It's presented as a chart, or excuse me, as numbers instead of a line or a graph. I promise there's no math. You don't need to do any math. I'm just going to make it simple for you. If we look at the 1 year and the 3 year, almost all of the categories, active funds on average, the typical active fund lost to the index. Most active funds in each of these categories. Now, there are a few where the majority of active funds outperform the index. But if you just go over to the 3 year, you'll see that at least for this period measured, which again is year-end 2018, for this period, all of the 3 year returns, the median active fund underperformed the index. So that's not great. Even at the 3 year, active decisions are not paying off. But if you advance a little bit, you go to the 10 year and the 15 year, it's incredibly lopsided. Even the best large cap value, if you look, is 79% underperformed. That's the best. The worst is 98%. So this is just great evidence that really you should, if you're at all looking at the long term, you should really be focused on index. It's incredibly difficult to pick a good active fund that's going to reliably beat the index. And this is for international equity. So if you look at the 1 year, if you look at the 3 year, you can see even at that period, most actives are losing to the index. But if you look specifically at international small cap and emerging markets, remember I said some people say those are bad for index and really a good active fund opportunity, but you can see here the median actives, they're losing to the index here. And it does not get better if you look ahead to the 10 or 15 year. Index does even better the longer you can wait. So that's really what I want to get across is if you're having trouble with a downturn, you're having trouble, you want to flinch, stop looking at it. Stop looking at it. Just let your index fund go, because the real lesson is these actives, they get nervous, they can't withstand it, they don't want all of their investors to flee, so they need to hedge. Well, that hedge is costly. So unless you really need short-term gains and you're willing to sacrifice long-term gains, index is better. Just stop checking it if you have the urge to flinch. I want to talk about when is an active fund a closet index. This means that an active fund is buying assets that keep it close to mirror an index, but it's still charging you fees like an active. And that's not a great situation. It's not illegal or anything. It's not anything nefarious or shady. Many of them are openly closet indexing. But It's certainly a question of is the fee justified if they're just going to closely match an index and then they're only adding just a little bit of special sauce, a little bit of their magic formula. You could get the same effect by buying an actual low-cost index and then buying a hedge fund, which has their magic formula or has just a little bit. So it's really, you have to wonder, is a closet index worth it? And often I would say they're not. They're getting the market rate of return, but they're charging you a lot more for it, and that's often not worth it. And sometimes they're underperforming the market, which is worse. So who manages these index funds? Well, there are tons. They are ubiquitous. A couple of the most prominent are Vanguard and Fidelity. Vanguard was the first. Vanguard has the biggest one, which is a total stock market mutual fund that is indexed and has almost 2/3 of a trillion when I checked their assets under management. So that made it the biggest at the time that I checked. Fidelity got a lot of news. They made a big splash because they had zero fee funds. There are tons of other players who do it. So who first came up with it? Well, lots of people were talking about it. People talked about how at the time, post World War II, a lot of active funds were not, all the funds were active, and those funds were not often beating the market. And there were many years where they were underperforming the market. And the defense from the money managers was, well, you can't buy the market. So a lot of people said, maybe you should. John Bogle founded Vanguard. He was the first to create an index fund that would let you track an index, and he tracked the S&P. They started adding more in the 80s, so it's become incredibly popular now. At the time, a lot of money managers met it with skepticism bordering on protectionism. They didn't like the implication, and they thought that it would sideline their importance. So there was a lot of protectionism when he tried to, when Bogle came up with it. But now the virtues of index fund have become incredibly obvious to a lot of people. Vanguard is actually named for a ship. It's named for the HMS Vanguard, specifically the one that served in the Napoleonic Wars for the British. And it's actually in the logo for Vanguard to this day. Just an interesting side note. Certainly it does matter for history if you're interested who came up with them, but Vanguard is not the only company that offers these. They are ubiquitous. You can get them all over the place, so don't feel like those are the only two options. They are all over, and everybody's got index funds. So now who am I to explain index funds? Why am I even talking about this? Well, again, I'm not a financial advisor, not a broker, not a dealer, not a professional investor. Explaining complex stuff is my hobby. I'm actually a tax attorney. I do employee benefits and executive compensation, including 401k plans, and investment options are important to 401k plans. And I do other related legal advice and arrangements, but don't take my word. I'm not advising you. I'm just giving you information. I think this is interesting. I like to explain it. But go ahead and do your own research. This should be the start, not the end of your research. And if you're comfortable with this, then maybe you should keep looking for more. And I just want to remind you again, I'm not selling anything. There's no financial or legal advice, and these are just my opinions. So where does someone get index funds? Well, generally, anywhere you can get mutual funds or ETFs, there will be index fund options. And that's generally true. You could get them through your IRA, through an investment broker. You could get it through your 401k or another DC employer retirement plan. They'll all have index fund options for the most part. So how do you know if it's an index? Well, first check the name. So does it say an index fund in the name? Well, here's the Vanguard S&P 500 ETF. And if you look right there, it says in the name S&P 500. And that is an excellent indication that this is an index fund. But you can also look at the fund fact sheet. I would suggest Control F search for the word index and see if it's tracking the performance of a specific index. So that same Vanguard ETF, if you look here, it says it invests in stocks in the S&P 500 index. Okay, interesting. Then you say the goal is to closely track the index. Well, that's the definition of an index fund. So there you go. They're telling you this is an index. But watch out if you do Control F for an index. Just because an index is listed does not mean it's an index fund. An index can also be a benchmark. So you can look at your active fund, compare it to an index, and see if it's doing better or worse. So just because it says an index does not mean it's an index fund. So a good example here is the Magellan Fund. And I can tell right away by looking at this that because the Magellan Fund is deviating from the S&P 500 at the year to date and the 1 year point, It's not an index fund, but you don't need to get that technical. If you just scroll down a little bit in the fund fact sheet, you can see the investment approach, and it tells you right there the fund's mandate is highly flexible. Well, an index fund is not a highly flexible mandate. It also says they find opportunities. That means they're using active independent judgment. So this is not an index fund, and that explains why they're deviating from the S&P 500. So you can just double check this if you're interested in watching the growth, and that should confirm what you're already seeing. You can also notice here that Magellan, at least for this period, for the 5 and 10, it was underperforming the S&P 500. So that's a little unfortunate, because you can see here, this is not the S&P 500, this is just a regular large growth portfolio, but you can see how closely the Magellan Fund is actually tracking to just a large growth portfolio similar to the S&P 500. So if they're tracking so similarly, and yet they're slightly worse than the S&P 500, why would you want an active fund? Well, if you look here, you can actually see their top 10 holdings are a lot of name brand companies. And if you pull up the Vanguard ETF, you can see right there a lot of the same companies. So the S&P 500 ETF is just buying the S&P 500. Magellan is supposedly being flexible and finding opportunities, but they're buying a lot of the same companies in the same proportions. So Magellan is a closet indexer. Not breaking any news when I say that. They helped coin the phrase closet indexer. But that really should explain why they are so close to the S&P 500. It should also explain why they're slightly behind it, because they are finding opportunities, and those opportunities are costing long-term returns. So that's one of those closet indexers, and it's really a question of whether they're worth it. So how else can you check if it's an index? Well, you can check the fees. Fees are no guarantee, but generally if it's more expensive, for example, over 50 basis points, it's probably active. If it's under 20 basis points, it's more likely to be index, but that's no guarantee. If you look at the Vanguard ETF, you can see right over here the expense ratio is 0.03%, or 3 basis points. Well, that's incredibly cheap, so that makes sense that that would be an index. But if you look at the Magellan Fund, you can see the net expense ratio over here is 0.67%, 67 basis points. That's very expensive, and that's consistent with an active fund. And you should also ask why you're paying so much for a closet indexer that's doing worse than the S&P. And then, of course, if you still don't know, you can ask, if it's an employer plan, you can ask the provider, you can ask the broker, you can ask online at personal finance sites, you can Google it. There are a lot of things you can do if you're still not sure. So you might be saying, where do I get off? You like actives. How dare I? Well, if you prefer them, if you understand them, that's great. If you don't understand index or you don't like them, don't invest. Don't be pressured. Never be pressured into investments if you're not comfortable. That's fine. I'm not trying to pressure you. I'm giving you information. Now, if you like active funds because they're fun for you and you like the excitement of beating the market and you want outperformance and you think you have unique insights, that's great. I would argue that's consumption, not strictly investment. You're mixing consumption and investment together. Kind of sounds like you've got a bit of a hobby, and that hobby is on top of your investments. And I think that's fine. Just be aware that consumption is not investment, and factor it in when you're making your decision. And of course, if you just trust an active fund strategy, you think that they have the right moves, you like their magic formula, you like their secret sauce, that's great. There are a lot of smart investors who use them. A lot of people much smarter than I, much richer than I, have gotten wealthier by using active funds. And if you know the risks, you know the costs, then make your own choice. I think the rest of us who don't know what we're doing, I think we're fine in index funds, but if it's really important to you, go ahead and prosper. So where can you learn more on index funds? Well, Investopedia is great if you need vocabulary and some basic concepts. It can be a little dense if you don't have much backing, but if you just keep rereading it, it might make sense. Bogleheads is sort of an online community of amateurs who really like Vanguard and name themselves after John Bogle. So that's a common community for people to talk about these issues, especially index funds. You can, of course, just do research through your broker, through your 401k, or your IRA website. You can read fund fact sheets and just keep rereading them until they start to make sense. And you can find places online to ask questions, like in the comments below. So let's go to a summary of what is an index fund. I like to do some quick takeaways. So remember, index funds, they invest in a group of assets. Index funds are usually lower cost than actives. The index fund will get you market returns, but most actives get below market returns. Therefore, most index funds or most active funds will lose to index. Therefore, index funds are good if you can just be patient. If you know you're not an expert, then you should consider index funds. All right, folks, so thanks for your time. I appreciate it, and I hope that you invest well.